help us make sense of the changes to the tax code, which we're all on the edge of our seats trying to figure out what the heck is going on, is Suzanne Jackson. Suzanne, thank you for joining us at the Bridge Club this evening. Take it away.
Okay, my pleasure. I will introduce myself as I've spent over 30 years in public accounting preparing tax returns for small to mid-sized privately held businesses. So hopefully that's what your audience is looking for. And here we are. I'd like to first have a disclaimer that hopefully my office chair won't squeak and make too much noise. So I'm going to toast to a quiet office chair, and also the topic being one that could be a snooze fest. So in hopes that it is interesting and that everyone takes something away without falling asleep during the presentation. Cheers.
Cheers. That's awesome.
So today I wanted to address three topics that in my review would impact the most small businesses in your industry. So I would like to start off by talking about the first section being the change to the corporate tax rates in the new tax law. With that, the prior tax rates went up to 35% on a graduated scale. Now it's a flat 21%. And most of you would know that the individual rates went from a top of 39.6% down to 37%. So with that, there is a wide discrepancy between the corporate tax rates and the individual tax rates. So with that, I would ask, how many of you are what they call a pass-through entity? And
what does that actually mean? Because I don't know if I understand what that means.
Well, that would be my follow-up question is, do you know what a pass-through entity is? And a pass-through entity would be any form of business that comes through and as included on your personal income tax return. So therefore, it would be if you're organized, your business is organized as a subchapter S corporation, a partnership, a sole proprietorship, a limited liability company. If any of those are how you're operating, then you are considered a pass-through entity. And now what you can see with your business is this discrepancy between, wow, the corporate rate really dropped all the way from 35% down to 21%, but my individual rate is still capped at 37. Should I consider being a C Corp, or how does this affect me? Yeah. So what they have done as part of the Tax Reform Act is put in a new 20% deduction for pass-through companies, i.e. your businesses, to try and equalize that or come closer to equalizing the discrepancy in the tax rates. This is where it gets complicated. So what we can talk about is this new tax reform was supposed to make tax preparation easier. And I can say with confidence that for the vast majority of folks that don't have small businesses and don't have pass-through entities, it will be simpler. But for those of us, including myself, with a pass-through, it is only going to be more complicated.
And why is that? Is it just because of all the exceptions, or what is making it more complicated?
Well, this 20% deduction that they have added for pass-through entities is an extremely complicated calculation. And what makes it complicated is first you have to decide what kind of business you are. So the distinguishing factor is what I would like to call as, do you make widgets? Or is your income dependent upon the services of the owners? So that 20% deduction is pretty clear cut if you make widgets and sell a product. And in general terms, if you had taxable income of $100,000, you'd get a $20,000 deduction. You'd be taxed on $80,000. So instead of the maximum rate of 37%, it's down to about 29% that you're paying, which gets you closer to the corporate tax rates.
Wow.
So that's if you are producing a product. But for many of us, you're a small business. They use the buzzword specified service business or trade. So that would include any of us who, in our business, our income is dependent upon us working. So me as a CPA, I don't make any money if I don't work on anybody's books. You as a veterinarian, if you're not servicing the animals and so forth, you're not making any money. So if your income is dependent upon your service, then you're a specified service business, and your calculation of this 20% pass-through is much more complicated with limitations. And the idea behind that is somewhat limiting or putting a service business in the same ballpark as a W-2 employee. So as opposed to a business making a widget that's selling widgets and paying taxes at one rate, those of us who are providing a service, they're putting in a different sandbox, sort of like a W-2 employee. So with that, what they've done is they've created a threshold. So if your taxable income is above a certain level, then it starts to phase out your ability to deduct the 20%. It's also your W-2 income comes into play, your entire family income comes into play. So just for hit and giggles, we'll show you this flow chart. Do not try and read it or understand it. I just show this to you as a visual of how complicated it is to figure out what your deduction would be as a specified service business. And the most complicated formula is over here, and this is where you and I all sit. So I'm not even going to, honestly, I'm not going to pretend to give you an example. I was reading one article, it was a 9,000 word description of how to calculate it. It's insane. What I will tell you is, as a single filer, tax filer, that threshold amount is about 157,000. And for a married person, it's 315,000. It's double. So if your income from your business is over those amounts, and this is including the business income, your spouse's income, any other income on your tax return, so your interest, your dividends, your capital gains, all of that gets added into this threshold amount in order to calculate what your deduction could potentially be.
For example, when you're saying that 315, you're saying that 315 is, in fact, let's say it's a married couple with 2 children. Okay, so it's the spouse's income. It is your company's business income, and if by chance you did something else that got you a W-2 or a 1099. If it's over 315, you're indicating that they would not get that.
It starts to phase out.
Starts to phase out.
Yeah.
Okay.
So in other words, like my husband and I are the perfect example. He's a W-2 employee. He gets a W-2. I'm a LLC sole proprietor, so I'm a pass-through, or I fall under those rules. And we have to combine both of our incomes plus any of our investment income, come down to what our taxable income is, and if it gets to be over that $315,000 rate, God willing, then we start to lose that deduction. Now, there are other items that affect that deduction besides the threshold amount. And the biggest thing that I can advise you is to talk to your own professional about it and run the numbers, because everybody's business is different. Whether you're taking a W-2 out of your business as an S Corp, whether you're taking distributions out of your business, whether you have a lot of equipment in your business, because capital expenditures, i.e. veterinary practice that does surgeries and has extensive medical equipment in their offices, those items all come into play in this calculation. And all that being said, I think one of the takeaways is it's going to be a challenging computation, but you're not going to be any worse off than you were in 2017. So they're offering a deduction. Presently for 2017, your pass-through income is taxed at the ordinary income tax rate with the rest of your non-investment income.
Wow.
With
So
this,
oh, no, go ahead. Go. I have a question when you reach a pause point.
Well, my point being is that I don't believe anybody is going to be worse off from a tax standpoint. It should hopefully only help you or reduce your taxes by offering this 20% deduction.
So from that perspective then, as someone is preparing to meet with their tax professional for 2017 and thinking about 2018, what are the kinds of records or pieces of information they need to have ready or keep differently to help their tax preparation professional help them reach the maximum deduction?
Well, what you're going to be trying to coordinate with your tax professional is, well, how much should I be paid in W-2 income and how much should I take out as distributions if you're an S Corp? If you're a sole proprietor, you don't have any W-2 income anyway, so that doesn't impact you. But the big point of that will be as you meet with your tax advisor is to have, as best as you can, an idea of what your next year is going to look like, and as far as an income, and really to be encouraging your professionals to do some estimates early in the year as to what the impact is going to be. Most of our pass-through businesses have to pay quarterly taxes in order to get the taxes paid in on that income from the pass-through. So that's going to be different than it is for 2017. There may be an opportunity to reduce those quarterly estimates. But it may be too early in the year to tell. If your business is new or if your income swings greatly between year to year, then you may want to just base your 2018 estimates on what 2017 looked like and go through the process and then see this time next year what the effect of this deduction did for you. It's not going to be as good as you think it is. I can almost promise you that.
That's what it sounds like. That has me, a little concerned that it's not as why couldn't they make it easier for the small business? Isn't there more small business than there are corporations just in the world? Why couldn't we get the easy side?
I would say that. And in fact, in your mind, you would say, well, the big corporations have the bigger staff and the bigger pocketbook to pay for all this complication. Us little guys, this is a real hardship to figure this all out. But there are a significant amount of large businesses operating as pass-throughs. You don't have to be little to be a pass-through. Mm-hmm. It just so happens that in the space that I operate in, and presumably you operate in, that's what we are. We're the smaller guys. The third thing that I wanted to touch on today that I believe will impact all of you is the changes to meals and entertainment. And that being that the IRS has changed the rules. In general, in 2017, meals and entertainment were 50% deductible for tax purposes. And again, in general, expenses related to employees for company-sponsored meals and so forth were 100% deductible. They've changed that. They've taken away the entertainment. There is no deduction anymore for entertaining expenses. And the meal expenses have been eliminated in some cases if they're directly related to entertainment. And likewise, your employee-sponsored, for instance, if you keep coffee and tea and a candy jar in your office for your employees, that used to be 100% deductible. Technically now that's only 50% deductible.
Wow. That's... We're taking totally all the fun out of it. And I was like, what? You're going to be kidding me.
Really? A bottle of bourbon we bought doesn't count. No.
I can't believe that. That's crazy.
Now, on the flip side, any social or recreational events that are company sponsored, for instance, a holiday party, those are 100% deductible. But meals that the company will pay for the convenience of employees are now only 50% deductible. And that includes your candy and coffee and bourbon or wine. So one of the things that I would highly recommend that you do sooner than later, because it is still relatively early in the year, is most of us on our record keeping for our businesses just have one line for meals and entertainment. And my suggestion would be starting immediately to separate that into 3 different accounts. One for where it's not deductible, one where it's 50%, and one where it would be 100% deductible. And the reason for doing this is because at the end of the year, your tax accountant's going to say, well, how much of that's entertainment? How much of that was the Christmas party or whatever? So 3 potential labels would be meals as one, entertainment as one, and then I've seen it worded social/recreational employee expenses. So that kind of lumps in the holiday party, the company picnic, those bigger items. And one of the other things that is very gray still, and I think this area will kind of unfold as this new tax law is kind of challenged a little bit, is in the past, if you were entertaining clients and you took them to the country club for a round of golf and then you went to dinner afterwards at the clubhouse, your membership at the club has not been deductible since, I think, 1986. But your round of golf, you could take a 50% deduction on. Now that's eliminated. There's no deduction for the golf. And if the dinner is at the club, it's questionable as to whether that's deductible or not. There needs to be a business purpose. And if the dinner is surrounding the entertainment factor, that's an area that can be challenged.
So for example, we're going to WVC this weekend, right? And so we're going to be having dinners and meals inside a casino. So what does that mean?
Good question.
Well, you're not paying for a sports event ticket. I mean, are you going to see a show? Because the show ticket would not be deductible now. That could have been 50% deductible in 2017 and prior.
No, so it's just like golf, right? Golf is outside. You go inside, you eat your meal. We are going to be right next to where there are shows. We're going to be right next to where there is gambling, which is entertainment. Right. But we're going to a restaurant that is right beside it.
I think you're still in the 50% deductible because you didn't go in there to see a show, and as part of seeing the show, you're going to have dinner. If you are going with the purpose to have dinner, and if there's a business purpose to the dinner, that's the first test: is who are you eating with? Right. You know, is it something that you could justify that there was a business reason to be eating? And if so, if there's not another entertaining factor, I mean, if you're gambling, the company's not going to pay for you to pull $20 out of your wallet to put it on the roulette wheel. So I think you're fine at the 50% in that case.
So how about in the case of a lunch and learn? I mean, a lot of veterinary practices will have all of their staff get together, and a lot of other businesses too have their staff get together over lunchtime and do an educational session or an update on something that's going on in the profession, and they will bring lunch in. So previously that would have been deductible, but is that now deductible?
That would have been 100% deductible under the old rule, and now it's 50% deductible.
Wow.
Yeah.
Well,
now on the flip side, if you were bringing lunch into the veterinary practice and the veterinary practice was paying you to bring that lunch in, then that would be 100% deductible.
Interesting.
And it would be a wash for you as well. In other words, you bill the veterinary practice $100 for the lunch. They pay you $100. You don't have to have a 50% deduction on that $100. It can be a wash, if that makes sense.
This is where those asterisks of how complicated it can get.
Well, I have like 4 pages of entertainment examples in a matrix to say, this is, this isn't, this is 0, this is 50, this is 100% deductible. And again, some of this I think is going to be unraveling as it's challenged by taxpayers because, you know, people will argue that there's a business purpose to playing golf and then going in the clubhouse afterwards and having dinner. And they're going to take that deduction. And until somebody says they can't take that deduction, then they're going to get away with it.
Wow. Interesting. Well, that takes us to 20 minutes, which is fantastic on this topic.
Yeah. Good information. This is really good information. I think that a lot of people are going to need to ask a lot of questions and start thinking about what we have taken for granted over the past several years. You know, the lunch and learns is a big one. For example, going to veterinary conventions or any kind of convention is another one where your habits are going to have to change, or not, but your deductibility is going to change pretty significantly.
Or at least your record keeping. You know, maybe you're not going to change your habits because that's what you do as part of those conventions and so forth, but how you keep track of it. And then again, the deductibility, you know, everything's deductible until somebody tells you you can't, i.e. the IRS. So I'm not suggesting that you don't do it properly, but if you feel that you can justify that that is a legitimate business expense with a purpose and a receipt, then I would take it.
Track it and try it.
Track it. Yeah, absolutely.
Track it and try it and see what
And
happens.
it's not going to be obvious if you're, you know, taking folks to a ball game or a golf match, or, you know, you're having a big bowling party. Although if you're having a company-wide bowling party, then that's different. That would be under those recreational and social employee services.
This is, to me, this has been incredibly interesting. Tax reform is touted as something that is so beneficial to everyone, especially the smaller businesses. But as you're unraveling it for us here, it is showing clearly it's making it more complicated than it was in the past, which means we've got to be paying attention more so than ever before.
Well, I would say, like I said earlier, those of us with pass-throughs, 100%, it will be more challenging. And I do feel that even though it's not an interesting topic and that most of us do rely on our professionals to take care of doing our taxes, I think it's valuable for you to be informed and at least know enough to go to your professional and ask the question and say, hey, how's this 20% deduction for pass-throughs going to affect me? And get your answers and have that confidence that you know what's going on with something as important as your taxes. Yeah. But you can't look at your pass-through in a bubble, because your pass-through income or loss comes through as part of your entire tax return or your entire family tax return. So you can't just think of one of this pass-through isolated by itself. You have to incorporate all the things that are included on your tax return.
So that's
this
helpful.
Has been fascinating. This is really great information, Suzanne. Thank you for taking time to join this.